Hey there, everyone. Ryan Schul here. Welcome to my data science channel. In the project today, I want to talk about the economics of trading stocks and all the implications of doing trades. Okay, so the economics of stock trading is somewhat convoluted. It's not too bad. I'll take you through it. But it's very interesting too. And you can think to yourself, okay, I can figure this out. I can get a handle on this, and you can do some pretty efficient trades and make some good money. But there's always things that are trying to erode the the capital that you generate from your trades, right? There's commissions, there's different buy-sell prices. They're called bids and asks, right? There's slippage with the bid and ask. There's capital gains tax when you make money, right? You can offset that with capital losses too. So that's nice that the government gives you that kind of opportunity. There's fixed trading size or percent of capital that you're trading, right? That could impact your overall profits. Taxes impact real profitability. Okay, if you make more money, you pay more taxes, right? So it's not just let's go do these trades and be profitable. There's a lot more to it than that. Okay, there's risk-adjusted performance. That's very important to consider. Avoid over trading with emotional decisions. You definitely don't want to fall in love with a stock, because I can guarantee the stock will never love you back. That is a mathematical certainty. It also helps set realistic expectations and prevents strategy decay, at least to some extent. Okay, the strategy could start to decay over a period of time. You could have a strategy that works pretty well for you now. Maybe in a few months it's not working anymore. Okay, so you have to be aware of that, and that can drag down your overall profits and returns. Okay, so I'm going to go ahead and import some data from Yahoo Finance. I'm going back in time about 36 months here. So 36 months relative to today. So we have the current date. The start is going to be current date time, that's today, and end is daytime now. That's what I'm getting, the daytime now, right? And subtracting out the time delta right here, okay? So we have the start and the end, and we're gonna plug that in right here. So here's start and here's end, okay? So that is the data frame. So when I hit Control Enter, I get a total of 753 rows. That equates to 36 months of historical stock prices and one price. This is the S&P 500. Okay, so this is what we're going to look at to do the trades. No specific stock per se. We're just looking at the index. All right. So I want to go ahead and get the rolling window for 5 days and for 10 days. So I'm getting a moving average of 5 days, moving average of 10 days, just so we can see, is the trend up, is it down, is it sideways, what is this thing doing? Okay, so let me hit Control Enter. Okay, we have our MAs set up. Now we can move on to back testing the strategy, right? So I'm going to loop through all the records here from 1 into the length of the data frame. So the data frame you just saw over here was 753 rows, right? So we're going to loop 753 times. And we're going to go through all the moving average 5 days, moving average 10 days, okay? And we're going to say this is a pretty simple trading strategy. I have a bunch of strategies on my YouTube channel, so if you want to check those out, just search for that. This one is pretty simple, right? If the moving average 5 day is greater than the 10 day, and the moving average is less than or equal to the 10-day average, then we're going to go long, okay? So the moving average looks like it's increasing, right? The short-term moving average looks like it's increasing. The long-term is decreasing. Otherwise, if positions equal long and moving average is less than the 10-day, then we don't enter into this trade, right? So if the moving average looks like it's going up, the 5 days greater than the 10, the stock is taking off, right? And it's starting to pop. So we're going to get into that position. Otherwise, we do nothing. We look for the percentage return here, which is current price minus the entry price, divided by the entry price, right? So it's always like end minus begin, divide by end, or current minus start, divided by start, right? So that is going to give us our capital over time. We are pending this into this list right here, okay? And then we will convert the list into a data frame. So let me go ahead and run this. So very simple trading strategy, looking at moving averages for 5 days and for 10 days. And then when that's done, I'm going to go ahead and plot the chart. Okay, and if you look careful, I'm using DF as the data frame. So DF goes into this plotly chart. X is the DF index. So the index is going to be the date. Y is the capital. This is the On the y-axis is the vertical axis. That is the total profits. You can see we started with 100,000, kind of dip down here. We had that down to 90. Then the strategy starts to pick up some steam. It's coming back. We're getting up to 100, a little over 100 here. Okay, now it's starting to pay off for us. Okay, and we're getting better and better performance over time, ending at 129,000. So on 100,000 investment, we made about 29, almost 30. So 30% return. Okay, but if you look close, there's no accounting for taxes or for for bid-ask pricing, for commissions, charges, things like this. But these are real world items that we are accountable for. We have to pay the taxes. We have to pay the commissions. Now you could have a commission-free trade. Sometimes brokers offer that, and they'll basically take the cash that's sitting in your account if it's not fully invested and lend that out to their customers in forms of margin, maybe even to other financial borrowers, maybe other institutions. I don't know what kind of agreements or contracts they have, but at least for margin, they could lend out that money, right? So if you give them more money, they'll gladly take that, but they're going to lend that at a higher rate than you could earn at a bank, right? That's how they make that's how they make their profits. So let's see, I ran that. So we had a $30,000 profit on a $100,000 investment. So not too bad. But again, there's no slippage costs, there's no transactions costs, there's no fees for trading fees, commissions fees. There's no taxes baked into this. Okay, so let's make it a little bit more realistic and add in some commission fees, right? Flat fee per trade, slippage percentage, okay, capital gains tax, 0.15. Now that's long-term. If you do a lot of short-term trading, it's going to be higher. I forgot what it is exactly right now, maybe 25% for short-terms capital gain tax and 15 for long-term. But you can just change these numbers to be whatever you want right here, okay? And then annual drag rate is 0.01. So this is the basically the inflation drag. So we start with 100,000, no positions initially, entry price is 0, capital over time is the name of the list that I'm creating and I'm appending to. So if you see down here, capital over time append, float capital. Okay, so it does a couple things in between here. Looking at daily drag for in range length data frame, that's what we saw before. So there's like 735 or something. What did I say? Yeah, 753. Okay, so we do 753 loops. Okay, and then we set the moving average 5-day, moving average 10-day. And again, similar strategy to before. If the moving average is increasing greater than the 10-day moving average, we're expecting the stock to take off. It's starting to pop. Otherwise, if the moving average 5-day is less than the 10-day moving average, then we're going to sell this, right? We get our exit price, which is current price, times 1 minus the slippage, right? We have to count for the slippage before, when we're looking at these examples over here. There's no slippage over here. Oh, okay. So just to make this a little bit more realistic, I'm adding in these extra like little gotchas, right? Like the commissions, the slippage, things like this. So we have the tax rate, capital and position equals none. So we're appending everything to a list and then converting that list into a data frame. Let me go ahead and run it. Control Enter to run. And let me plot the results. Okay, so accounting for most of these main items now here that are going to drag down the overall return on the portfolio. We've accounted for a lot of these, not every single one, okay, but most of them. So now we start with 100,000. Again, dips down a little bit, but then starts to come back. So we're doing good. We're back to break even. Now we have a profit, 115K, and we end at just about 112, right? So all those commissions, transactions, costs, taxes actually took a big chunk out of our profits. Before we had a 30% return. Now, in this much more realistic scenario, this is more real world, we only have a 12% return, right? We really got 30, but what goes into our pocket, it's only 12%. So actually a little bit more. So 15 would be half of 30. So we're actually paying more than half of our capital gains back to cover all the costs from the commission and the slippage, bid-ask spreads and things like that, really. So that's kind of a big hit to the portfolio, right? You're getting actually less than half, but you do have to account for these things, right? And this is much more realistic. So let me just take you through a couple more things. These are some basic financial metrics that we look at whenever we're doing trades. The Sharpe ratio is the actual return minus the risk-free rate divided by the standard deviation. You can see that right here. Okay, and we're calculating all of these returns right here. Here's the mean, here's the standard deviation. So pretty simple. I love how Python is so efficient and so elegant. All you need is one line of code to get the mean return for the whole portfolio. All you need is one line of code to get the standard deviation for the portfolio, right? And the risk-free rate, I think I'm setting that to 0 right here. It's pretty low. I don't think there's like really risk-free rate of 0, but for our purposes here, I think it's okay. So I could change that to point. What would it be? 1.02. Maybe that's a little bit more accurate. Okay. Wait, it didn't like that at all because that went negative. 0.002. Is that it? Oh, and then I have to annualize it. Okay, probably like this. Okay. That's negative again. Let me leave this at 0 right now because something looks a little bit off, but it is going to be pretty low rate, right? Probably close to 1%, 1/2 of 1%, even 0%. I think is okay in this case. So we have our Sharpe ratio analyzed. Here, the maximum drawdown is the percent drop from the peak to the current value of the portfolio. Okay, this is always going to be negative unless you never had any drawdowns whatsoever. That's pretty rare. Standard deviation is the volatility of the standard deviation of the portfolio, right? So there's a standard deviation. You divide by, or you multiply by 252 because it's 252 trading days in the year. Remember, the year obviously has 365 days. I think we can all agree on that. But the market is closed every Saturday, every Sunday. And then I believe there's 11 holidays. So you'll have January 1st, the market's closed. December 25th, the market's closed. Labor Day, Memorial Day, Thanksgiving, you get the picture, right? So there's about 11 trading days. So if you take 365, subtract out 52 times 2 for every Saturday and every Sunday and add 11 to that, you should get to 252. So let's go ahead and print this result right here. We see the Sharpe ratio is 0.44. Maximum drawdown is 11.2%. So we lost 11.2% at the max. That's not too bad for a portfolio. Some lose way more than that. The mathematics get very interesting too. So the more you lose, the more difficult it is to recover. So if you have a stock you bought it for $100, it goes down by half to 50 just to break even. To get from 50 back to 100, you have to go up 100%. Okay. So how many among us are making 100% in the stock market on a regular basis? I don't know too many, right? So the key is not to lose a whole lot of money in the stock market because everything you lose has to go back double just to break even, right? So that's going to be hard to do. And not everything goes 100%, but the more you go down, the more you have to come up, right? If you go down 10% to get back to break even, I think it's like 11% or 12%, whatever. But if you lose 50%, it's another 100% to get back just to where you were before the loss. Okay, so it really takes a toll. The goal is to not incur too many losses, but almost inevitably you will have some loss, right? So this is a good start. There's other things we could do to take this a little bit further. Bid-ask spreads, inflation. We didn't account for inflation. Leverage, right? We can lever up and trade more money. And if we borrow money from the broker, right, they're going to charge us an interest rate on those loans that they're lending us the money for. But if you just invest half of your money and the other half is the broker's money, and you make that your return, you're really just paying off the broker a small percent for interest rate for that loan, but your initial investment was just half, right? So your return is almost going to be double. But then if the market moves against you or somehow you get whipsawed, it goes down, you sell, and then the market comes back and you get left behind, that's going to be difficult to deal with too and to absorb those losses. So leverage can be a very good friend or it can be a horrible enemy. So you have to be careful with these things. And margin call too. If the stock goes down to a certain amount, the margin will be called back and the broker will automatically sell your trades and claw back all that money, okay? Because they don't want to suffer major losses, right? Like maybe you will say, okay, I'm just going to gamble it away and wait for everything to come back magically. Well, the broker's not going to let that happen, right? If it goes down a certain threshold, there's going to be a margin call and they liquidate and they dump everything and then you have to eat that loss. And that's very painful. I've had that happen to me. Okay, that's it, guys. So I just wanted to take you through the economics of trading stocks. We're using Python for everything. I am going to save this Jupyter notebook. I will export the code and I will share everything with you guys when I drop this video a little bit later today. Thank you so much for your time. I appreciate it. Thanks for sticking with me to the end. I'm going to wrap it up here, and I'll see you soon in the next video. Bye.